Good morning, and this is Stephen Aquario from the New York Association of Counties, and thank you for joining us today on April 24th, 2020, for a budget webinar, County Budgeting Through the COVID-19 Pandemic. At the outset, I'd like to salute and thank you, the county officials of New York, the epicenter of the United States, for the COVID-19 pandemic. Commend you for the tireless amount of work that you have put into serving your community. When one signs up for public service, one could never think it would be this. And the elected officials, the chief elected officials, I salute all of them and their hard work and dedication to protect the public's health, the local health departments, administrators, and the finance and treasurers who continue to help stabilize and understand the financing as we go through the COVID-19 pandemic. We're pleased to present to you a session today that can help you and help each other as we go through the COVID-19 period of time, beginning in March and ending ? I talked with many people throughout these weeks and months, but I was talking to an accounting firm, the Bonadeo Group, yesterday, and talking with them about how they're advising their municipal clients. What are the questions that they're asking? Things like, where am I now with our finances? What will my finances look like in 2 months, in 4 months, in 6 months, at the end of the calendar year? What short-term decisions should budget, finance, treasurers be making right now? What needs to be made? What decisions need to be made in the near term, the short term, in the medium term, and in the long term? What is the impact of the economy? The loss of hotel, motel occupancy tax, tourism, the loss of sales tax. Which industries have declined? The automobile sales industry, down 25%. Gasoline, down 25%. Look at the price right now of gasoline and dropping. Clothing and retail, restaurants and food service, appliances, all down 25%. Will this just be the second quarter? Will it be the third quarter? Will businesses have to reduce the price of their goods, of their accommodations and products when we reemerge, resulting in lower sales tax revenue collections to government, state, and local? Which businesses will survive? Which ones won't? The amount that we're talking about is substantial. It's important to discuss because outside of the city of New York, the counties are collecting over $2 billion in the second quarter alone last year. So projections at this time in this quarter really matter to county governments. What happens in the business community ultimately happens to our taxpayers. So there's many firms out there that can help, and county budget and fiscal experts can help as well. As I mentioned, the Bonadeo Group out of Monroe County has outlined a few things when they were speaking to me about their municipal clients. Forecasting. Budget officials like predictability. Even if it's bad news, at least the budget officials can plan for it, prepare for it. Understanding cash flow analysis. What flexibility do we have in local government with respect to cash flow? Budget analysis. What were the assumptions used in September and October when we put our budgets together? How can we test those assumptions now? What is the impact of the stimulus funding for counties above 500,000 and below 500,000? What are the areas likely for funding cuts from the state of New York? At what range can we expect? Financial considerations, short and long-term borrowing options, new financing tools, amortizing deficits over a period of years. We're working on new legislation that would allow local governments to issue deficiency notes for up to 5 years. We're presently limited to 12 months to redeem a note. What leeway do we have to make school districts whole for delinquent taxes that are owed? Can we delay those payments? Can we defer those payments? What types of contract analysis is being undertaken right now by county governments for vendors? What flexibility do we have in those contracts for collective bargaining agreements, hiring freezes, telecommuting, cybersecurity protection, outsourcing? And finally, many of you are working with banks, and understanding the banking relationships critical. We'll have our NYSEX financial partner, 3+1, on this call today with its Casvest product, and we've asked them to tell us specifically a little known aspect of budgeting, liquidity, and how that's more important more than ever right now as we work through best guessing scenarios, replacing thoughtful budget deliberations through what was a committee structure in-person process, and how we prepare for the next quarter, or how we begin to prepare and shape 2021, all being done remotely. Its major presentation or focus will be on a liquidity analysis. We're not talking about cash flow here analysis, it's a liquidity analysis. The patterns of liquidity data, both over the past several years, the present and future, can help position the county governments to move assets into revenue generating accounts to help stabilize and better prepare the counties for tomorrow. So let's get going. First up, we'll go to Robert Keating in Erie County. And Bob will talk about creating a disaster fund, tracking expenditures, borrowing, cost control measures, a true expert in municipal finance. Bob, thank you for joining us.
Thank you so much. Thanks for having this call. I think it's really critical at this point in time. We've been through this before. I mean, certainly not as bad as this. With before we've had major snowstorms, and we worked with FEMA to get costs reimbursed and and cost tracking and so on. So in this case, we felt the same thing was needed here. So we created a special revenue fund, the COVID-19 response fund, and working with all county departments and elected officials for costs that are truly COVID-related costs, new costs that were not they were not in their normal budget, to record these expenses in the new fund. And I mean, we got some good news yesterday. We received $160+ million from the U.S. Treasury from the CARES Act. Again, we really can't use that for general revenue loss or for general costs, but that is certainly a backstop as we'll be claiming costs to FEMA. There's other grants, maybe like some CDBG programs, but the CARES Act funding is certainly a backstop that we expect any COVID-19 costs to be fully reimbursed from various sources. So we're tracking expenses. We're working especially with like the overtime costs. We have like call-in center. So we're having a process, like a sign-in process. So when we do have to claim this to FEMA or whoever, we'll have decent records that will support our costs. Again, the issue, another concern we really have now is cash flow. I mean, working with our controller's office, who was our chief fiscal officer, our cash normally at this point is in great shape, and if this was a normal year, would not be a problem. But we expect without any special action, we'd be running out of cash by the end of May. So we had got legislative authority to issue a RAND for up to $125 million, and we are taking steps now with bond counsel and our fiscal advisor to price that RAND. We are initially trying to do a direct placement, but I mean, we're exploring every option. It was encouraging. Like the city of Buffalo did a ban last week and got a rate of, I believe it was 0.94, and we're hoping that the rate we receive is under 1%. That's the key, because earlier we heard rates as high as 5% when the crisis was first starting. So we're working with our partners to get this RAND placed, and that at least would solve some cash flow issues temporarily at least. Let's see what else we have. And we're taking steps also. Again, we're trying to control costs where possible. So we implemented a hiring freeze. It's not essential, not critical work. We are not hiring new people. We're not filling positions. Any cost that is non-critical, we're just not doing. So we went through all our capital projects this year. Which ones are truly critical? And we broke them into the categories. If it's critical, we'll find a way to do it. And if it's not, we'll do it not at all or later. And that's really going to help out. Just basically any area, any cost that's not critical, we are trying to just really defray it. The county controllers, they're the chief fiscal for the county. We're basically the operating area, and they manage the cash flow. So we're working with them very collaboratively every day. We go in discussions. Any cash disbursement we discuss, is this critical? And if we do this, how will this affect cash flow going forward? And it's been a great relationship, and we're building on that. And there have been some positives. That's a major positive. In addition, the telecommuting thing is we never had that ability before, and now with technology, we've had many meetings, from home, and only people at work are the ones that are actually critical that need to be there, and it's worked out really, really well. So there are a few positives that when this thing ever does end, we can build on those. The next part is I was doing like a revenue projection. I basically decided to do the worst case. It's something where, again, we don't know. It's like we will get our first real sales tax dues in early May when the first receipt comes in, which has some April sales and some March sales, and especially I'm really looking at the April EFT portion of that. And you look at all the major categories. I mean, we know car sales are down. We know restaurants, tourism, department stores. So many of the major categories are going to be totally impacted and almost like wiped out. So we're very conservatively estimated, sales tax for really the April sales, and then going forward the rest of the year. I mean, really the county through March, because of the state budget actions last year with expanded internet sales, our sales tax through February was up 8%, which is normally be incredible news, but we expect March will lose, and then end of March will be break even, and then after that it'll basically fall off the cliff, and we just have to be ready to deal with it. It's so critical. The next level of federal funding includes money for the counties and other municipalities, and we are fortunate we got the CARES Act money because we're a large county. I mean, unfortunately, other counties didn't get the CARES Act money, so they're in a different boat than we are. But hopefully, we all work together, and the Congress we could work out something and where we all get some reimbursement that's critically needed. If we go through our budget this year, we have no way to make it up. It's enough without federal money. There's just no way we can cut spending all we want to, but there's so much mandated spending, and we need sales tax. That's the way our budget is structured, and that's going to be a problem. It's going to be a problem next year too. But the first thing is getting through this year. We are, like with borrowing, we are going to expand at we have a capital program this year. We are going to either consider doing bans, depending on the rates, bans or bonds, and we're looking at the market and working with our partners to do what's best. If it's not good to borrow this year, or not good to do a ban this year, we'll hold off and only do the critical projects and fund with the cash from the RAND. Again, the main thing to follow up is we need that federal help there in the next set of legislation. Happy to take any questions that anyone may have.
Okay, Bob, we're going to take questions at the end. So let's talk with Tim about workforce options. Tim is a Schuyler County administrator, put a lot of time very early on talking about workforce issues, temporary layoffs, they're called, furloughs. Government can't really furlough people. It's more of a private sector term, but we can, at management discretion, require temporary layoffs or abolish positions. You did something very early on in your county in this regard. Can you tell us a little bit about your workforce reduction plan?
Sure. Thanks, Steve. Happy to share our experience. Next slide, please. And just by way of background, we're a small county, a small population. However, we are heavily dependent on tourism and agriculture as the home of Watkins Glen International and Watkins Glen State Park and a whole other host of natural resources, and are currently receiving in excess of 3 million visitors a year. The economy up until now has been extremely strong and experiencing double-digit growth. On the agricultural side, 80% of that economy is dairy, which, as everyone is aware, is taking a very hard hit right now as milk prices plummet. So I mention this because even as we contemplate recovery and reopening, given that we are so heavily dependent on outside visitors, if we open everything back up, our local population, even our regional population, can't support the businesses that we have. So our recovery, I think, may even be slower than most because of our dependency on visitors from other parts of the state, the country, and the world. Also, to put in context, our total tax levy is $11.2 million. So as I said, we're not big. Ironically, and compounding this is that we are probably the least impacted by COVID-19. As of yesterday, we've had a total of 9 confirmed positive cases. All 9 have recovered. There have been no hospitalizations and no deaths. This is frustrating on that respect. I suspect our public health impact will pale in comparison to our economic recovery impact. So next slide. So again, as Steve mentioned, we are one of the first counties to actually, and I am using the word furlough, even though there's differences of opinion as to whether a furlough or a layoff takes place in the public sector, but influencing the factors, as everyone's aware, the recently adopted state budget gave the governor the unilateral ability to make adjustments to balance the state budget. Considering that there will be no or very little state income tax revenue until July, we are almost guaranteed that the 2 checkpoints of reductions or ability to reduce the state budget will create that opportunity. Beyond that, the executive orders that we're all complying with regarding both workforce reductions and social distancing being extended through May have certainly added to the challenges that we're facing. We as most, I'm sure, reduced our workforce as directed and very quickly converted to telecommuting and remote work, and amazingly so. But we still have a fair amount of the workforce that was not being fully utilized as a result of that. And as everyone is aware, all employees under the executive order continue to be paid, and accruals could not be charged for that. When the federal stimulus was adopted, and then we became aware that unemployment insurance payouts could be increased across the board by $600 per recipient, and furthering that the employer's share of the unemployment cost were reduced by 50%, it caused us to begin thinking about what are we going to do to try and stave off the inevitable economic disaster that's looming. Next slide, please. So in terms of trying to do some projections, in Schuyler's case, the numbers aren't big. However, they represent the estimate that of between state reimbursement through the governor's unilateral ability to cut, sales tax reductions, room tax reductions. This really results in our case of potential revenue impact of 25 to 40% as you compare it to our tax levy. So it was clear that we, as was mentioned earlier, it's very difficult to cut enough to offset that, and almost impossible. So we began considering, at least temporary workforce reductions. As I mentioned, I call it a furlough, because our contemplation was to take advantage of the opportunities that have been presented through the federal actions and increased unemployment insurance. And I'll elaborate further in next slide. So, in looking at all of the aforementioned and trying to put this into a timeline of, from the concept to the action, literally was a week. I started with, calculating the financial impact calculations, both in terms of what the savings to the employer could be, as well as what the impact on the employee would be as well. We did reach out to both our county attorney as well as outside labor counsel to discuss the concept. I asked our human resources office to research civil service law and contact state civil service, which she did, and then discussed it with the administrative team, very shortly thereafter. The criteria that I outlined for selection for furlough or temporary layoff was basically very simple. We took the low-hanging fruit first. Any employee who was not assigned any job duties, there were only a handful of within our organization that we couldn't find something to do, but nevertheless that did exist. And we had employees that were receiving full pay with no duties assigned to them. And then in order to meet the 50% reduction in workforce goal, a number of employees were assigned remote work, but because of the reductions in functions in some offices, we wound up sharing duties with that. So basically, employees who were not assigned any duties, and then employees who were splitting positions, we combined those positions, and I put forward the concept, let's give me what it would take to assign full-time work to everybody that it's available for, and what would be left, from there. And the list of what was left became our furlough list. We met with and I will share the financial calculations at the end of the presentation as well, to show you, to highlight what we actually did. Met with the union leadership, both our employee leadership as well as the LRS, on the 14th, and then I took it to the legislature that evening. The legislature unanimously accepted the recommendation, and at the end of close of business that week, we furloughed 32 staff, which in our case represented just under 13% of the workforce. Calculating the net savings, factoring in what our employer share of unemployment would be, that represents for us a savings of $88,000 a month. We've rolled it out to staff with the understanding that we would be doing 30-day increments. It would be reevaluated on a 30-day basis. However, should anything change, we could bring employees back at any time, and we left it, at that. Next slide. So in considering the parameters, and there's been a lot of discussion regarding negotiations of this, we considered this to be a management right. We didn't negotiate an MOU or MOA with the union. However, I would not be adverse to doing that if we take the term negotiate out of the term. I have no problem codifying what we did, and this will illustrate why, but we were not going to be dictated as to how we would do it. So the first premise, and as the governor often says, was to do no harm. We did not want any employee to be financially harmed by this, and with factoring in the federal stimulus funds, in all cases, every employee that was affected by this makes more money than what they would have made had they stayed on the county payroll. We looked at this as a proactive approach. If we do temporary reductions now, especially where nobody gets hurt, hopefully this preserves jobs for the 2021 budget year. I did state to our staff that any furloughed staff would be reinstated. That's a guarantee by myself and the legislature. As I mentioned, no staff members' weekly pay was reduced. We also, as the employer, agreed to not only maintain health insurance, while granted, your regular contributions remain in effect, but also allow staff to continue to accrue vacation and sick time. So that again, the goal was to save money, but not do it at the expense of our employees. We've been in effect. This is the first full week of instituting this. At this point, it's seems to be going with no major issues. I'm not aware of any issues, quite frankly. But that's a quick snapshot of how we handled it. And then the next slide will outline. This is just a very simple calculation, and using our Department of Social Services as an example. I just took the employees that the department heads offered up as meeting the criteria for furlough, calculated what they would make right now, what they would normally get under unemployment should they be laid off or temporarily laid off, and what they would receive currently because of the stimulus. And you can see in all cases, and in some there are substantial increases. The lower the income, the higher the differential in terms of increase in take-home pay. But that's a very quick overview of what we've done. I'm happy to, at the end of the presentation, to go into greater detail or do a deeper dive should anybody wish more information on that. So hopefully that covers that base.
Okay.
Thank you.
Tim, thank you very, very much. Next, let's go to Mary Gates from Ontario County. Mary will talk about one county's attempt to estimate lost revenue from sales tax. And we're very pleased to have Mary, who has developed some internal working formulas within Ontario County that she has shared with others around the state, and that got a lot of people's attention. So we're very pleased, Mary, that you're able to join us and talk about some forecasting in sales tax.
Sure. So good morning, everybody. Obviously we're wishing we didn't have to have these discussions, but hopefully what I have to cover will help a little bit. Our largest, like many of you, most of you, our largest revenue is sales tax. That is what the big issue is for us currently. So how did we decide or try to analyze how much we were going to lose in sales tax? So where we started was with the sales tax vendor report from Department of Taxation and Finance. That's the ST-250. That provides a split by county, and it gives everything broken out by quarter for the last 3 years. But the biggest point is that it codes everything by NAICS codes. So if you go to the next slide, on the next slide, we'll see that allowed us to be able to target the different types of businesses. Now, this is going to sound like a very daunting task because anybody who has seen this spreadsheet knows it's massive. Ours is about 26,000 lines long. But if you hide the columns between the business and the NAICS code, it's actually pretty easy to process through this. And then just sort by NAICS codes. There's certain sectors that you can avoid taking out. So for instance, like the first two numbers indicate what type of sector it is. So if it's a 22, it's utilities, those were not affected, but 44s and 45s retail were. So we went through that, and what we chose to leave in was things like, so we pulled out the majority of the clothing and merchandise, but we didn't pull out Walmart, Target, BJ's, obviously, because those are still getting activity. But you can go through that NAICS code list and you can figure out which departments or which programs or businesses are probably closed. So on the next slide, you're going to see where we ended up. Now, this is not an exact science. We're estimating here. But I took out all of the businesses that we figured were closed based on those NAICS codes, and then I figured out how much we had left in sales tax that we could expect on a historic basis. Now, I just pulled 4 quarters out here to show on the slide, but then I took our total sales tax and figured out what our loss was. So you can see we were right around 43% pretty consistently. I translated that into a daily rate because that's going to be easier for me to figure out what our losses are actually going to be. So on the next slide, you're going to see where we took the average loss per day of about $93,000, and then we went from March 22nd, which was when the largest retail areas closed in our area, and we are very heavy on retail and automobile sales. So I just calculated how many days it was between, well, let's see if they can open May 1st, we'll have lost 3.6 million. If they can open June 1st, how much? If they can open July 1st, how much? So we wanted to have some various scenarios, if you will, best case, mid-range, worst case scenario. So that gives you what you have there after you go through that process. What you have there is the amount of estimated lost revenue just for the total period of full closure. So on the next slide, we start trying to figure out what the recovery is. And we don't know what the new normal is. Nobody does. But we know there's not going to be a light switch. People are probably going to be a little resistant to crowds, which might affect how they go to larger retail establishments. There's been layoffs, and to be honest, there's probably more coming once the government areas and the schools react to the revenue stream reductions and the decreased funding that we're going to get. And then discretionary spending is gone down and will continue to go down. Now, part of that is because of layoffs, but then also part of it, I think, is the fact that we've got people that are going to be trying to figure out how to make up some of those losses in their investment accounts. But then also this is going to bring into focus how important having reserves, even from a personal side, is important. And people, I think, are going to start looking at savings, or I hope so. So on the next slide, you'll see that we started the recovery of sales tax slowly. So for the first month back, we assumed maybe 35% of the sales come back. And then the second month, 45%, and so on and so forth to 80%. Now, again, this is in the 3 different scenarios that we looked at originally, the May 1st opening, June 1st, and July 1st opening. But this gives you an idea. I calculated these out based on the actual loss so that it was easy to just add to the previous total loss numbers. And then you've got your estimated loss and sales tax for the year. So if you go to the next slide, one of the things that you really need to think about is this is just one method that we used from our perspective from Ontario County. This is going to be different for everybody. So when you're looking at the loss, you've got that total loss, 100% of that didn't really go away. Some of that stuff is going to move online. Some businesses didn't really close. And then, what types of businesses that you have, how weighted are you in your sales tax? Like I indicated, we're really heavy on the retail and automotive sales side, but you may be different. So you want to look at that differently. So to adjust for that, I took that total loss and I assumed we'll realize 75% of that loss. Again, it's going to probably be different for your area. And then in figuring out how to show that recovery going out for each individual month, you want to look at the fact that we know businesses, they didn't all close at the same time, and we know they're not going to all reopen at the same time. Like it or not, we know we're going to have some businesses that just are not going to reopen. I mean, we're focused on a new campaign for Ontario County, and the maintain the cap or keep the cap worked for us. So now our new campaign is protect the tax base, because that is going to be very important. So helping those businesses so we get as many of them reopening obviously is going to help this as well as many other areas. But that is one of the things you need to think about, is how much of that lost revenue really is not coming back. And then again, what is the meat and potatoes of your sales tax? Where is the majority of your sales tax coming from? Because wherever that is coming from, that is going to affect how you analyze this. So I know they posted a spreadsheet on the webinar here, and I think they're going to put it on the website when they post everything to the website. There is a spreadsheet that's got all of the formulas for the calculations that I did for the full loss and then the phased in approach. So I hope that's helpful for people. I hope this conversation's been helpful for people. And reach out to me if you have any questions. I'm happy to help anybody if you need any help, or this crazy stuff I came up with doesn't seem to fit your area and you want to toss some ideas around. I'm happy to help.
Mary, thank you very much. We appreciate the methodology that you've used to stimulate thought, to begin to understand quarter 2, quarter 3, quarter 4, what types of industries are affected. Very important for counties to be monitoring that, understanding it, digging in through it, and we appreciate it very much. Let's go to our last presenter and then start taking some questions. Again, please submit your questions. We do see several on the dashboard. Liquidity. We've asked our financial partners at NYSAC, who work with many of you already, and several municipalities and school districts and community colleges around the state, our partners at Casvest, to understand liquidity, why it's important right now, and the banking relationships that are critical. Let's go to Joe Rulson and Garrett MacDonald from 3+1. Joe?
Thanks so much, Steve, and to everybody, really appreciate being able to present along with Garrett. I have to tell you, with what Bob, hearing from you and Tim and Mary, very, very impressive, and how you're taking proactive measures in looking at a crisis that none of us have ever experienced. I'm treasurer of the Monroe County Water Authority, and we had a meeting yesterday, did our social distancing, and the first question that came up is, where do we stand? And we're finding we're about where we expected to be. We're seeing very little slippage in terms of monthly payments. But I think you say it so well, Mary. It's a new norm that's going to be taking out there. And a great example is a major store had a sign up that I thought was very interesting. And it is a change in behavior for all of us. And it said 3 items that cannot be returned. Number 1, any produce cannot be returned. Number 2, all dairy cannot be returned. And 3, if they're not mentioned in the first 2, they cannot be returned. And that's a whole new norm in terms of the idea of going to Target and being able to return something. That's not happening. And that was one of the reasons why Target came out with increased sales numbers yesterday. But it's changing, and it's changing how we look at the marketplace, how we look at how you deal with a major crisis that we've never seen of this level, and how do you deal with the uncertainty. And trying to deal with uncertainty is an important part of liquidity, and being able to look at liquidity and knowing where do you stand from what is the norm to what is not going to be the norm, and what are the different areas that you can pull out to drive some assumptions so you can see where you stand, and at the same point be able to know what cash do you have to deal with, not cash flow, what actual cash do you have on hand, what do you actually need versus what you think you need, and what do you do in between with those dollars to make sure they continue to earn revenue, and they do, and they still can in this environment, while also using all the possible tools that are available in having liquidity help you through budget time, to having you help it through crunch time, to have you help it through crisis. And so I'm pleased to have Garrett on with me to be able to go through some points that are items and actions that you can take today that will in fact help you to address the COVID-19 crisis. And it is not an easy marketplace. Working remotely, I just can't tell you how you're all the heroes out there. You're in the front line, you're dealing with how to keep government running smoothly under unusual circumstances, and yet you're not skipping a beat. And so I want to thank you for that, and at the same point let you know that there are tools that are available to make life easier, help save money, help so you don't have to have as a severe budget cuts by using some of the different techniques that we're referring to. So with that, Garrett, we'd love to have you go through those 6 different areas.
Thank you, Joe. And thank you for everyone's time today. So if we could go to the next slide, as Joe was referring to, we're trying to look at the 6 liquidity considerations during this COVID-19 crisis. And really, it all comes down to data. And short-term liquidity forecasting is very separate from the long-term budgeting picture, both extremely important. But today, we're trying to look under every stone to find out where can we pick up an extra 10,000, 20,000, 100,000. Spoke with a large entity yesterday who in the next 60 days will be earning another $300,000 by looking at the difference between what they have and what they need. For the past 6 months, the focus really has been on how can we maximize the value on every dollar that we have, because interest rates were fluid, banks were competing. It was a time to find out, wow, if we can earn an additional $100,000, $1 million, maybe more in interest income on general fund, that makes a big difference. Today, looking at the difference between cash flow and liquidity and the short-term dollars that you have between 1 to 30 days availability on can really make a difference over the long term. And the difference really in that short-term liquidity forecasting picture, the cash flow picture and the liquidity picture is when you write a check, from the general ledger perspective, you're recording that cash as being expended, as being gone. But the bank still has to collateralize it. Sometimes you may or may not be earning interest on it, and the money still hasn't cleared the account. So how can we look at maximizing the value on that liquidity and separating it out from the long-term budgeting perspective? And it's all about looking at data. The table that you see on the presentation is showing you a 5-month forward forecast on short-term liquidity. That's liquidity available between 1 to 30 days. So the first liquidity consideration would be take into consideration your budgeting and your long-term forecasts, but separate that out from your short-term liquidity situation to find out how can we maximize the value on that dollar. Number 2, it's not rushing to judgment. Working with a lot of different entities and counties around the state, and a lot of them coming and saying, we really need to identify what the implications are because we're not going to have cash, and we need to find out if we need to borrow. What different scenarios do we need to walk into? And we're trying to help them through assuming no shortfalls are all going to happen at one time. So looking at how to maximize the value of those dollars, because it's going to be a slow process. Even as Mary indicated, it's going to be a slow one down and a slow one back. And so looking at those shortfalls at not happening all at once is so important. Maximizing the value on every dollar, because not all dollars spent tomorrow, it does take a little bit of time. Number 3, what are your compensating balances with your banks? What are the fees that you have to pay your banks? What amount of cash do you have to keep on deposit so that you don't get hard charged? And a gentleman said yesterday to me, Garrett, that is not the priority right now. And I totally understand that. But it's looking at every stone and identifying, again, if we can save $50,000, maybe more on managing our short-term cash, that can make a big difference, right? What is a reasonable rate of return right now? It is a myth that you can't earn any interest on any cash. I've seen interest rates in the last week from 5 basis points to 100 basis points to 1%. And it's really looking at your investment policy. This is a great time to look at your investment policy, make sure it matches the New York State Comptroller guidelines, make sure that everyone's on the same page with what your investment policy allows you to take advantage of. And there's options and tools available. And what options and tools can we look at to make sure we are taking advantage of everything in the marketplace? If you don't pay any banking fees, a lot of times, this was the only time in history where the 1 month, the 3 month, and the 6 month Treasury bill were either negatively yielding or zero. And someone called me and said, Garrett, are we going to be charged for keeping our cash in the bank? I don't think that's going to happen. But what will happen is if you work with a large institutional bank, and I think banking partners are paramount. We have to have a great relationship with our banking partners. But if you work with a large institutional bank that has line item fees, those are likely to increase. And your earnings credit rate, the amount that's used to calculate what you have to keep on deposit, is likely to go down, which makes the amount of balances have to increase. 3, how can we use all liquidity during this time of uncertainty? It's really looking at your toolbox. Now is a great time to practice fund accounting and look at all areas of liquidity on how to balance cash that you have and expenditures that you have, and take advantage of where you can use your entire liquidity position. Cash flows looking at each fund individually, or sometimes I even work with some entities that have a different bank account for each budget line item. We can look at all of our liquidity as a whole. We can stress test it, run different simulations on it, as Mary said, and you can really look at maximizing the value on that. On the next slide, number 4 and number 5, what is your full toolbox again? What is the full opportunity that your investment policy allows for you to utilize and to have? And knowing the difference between that general ledger and liquidity perspective is paramount. And finally, 6, are you confident you can operate a decentralized finance office, right? This is a really good time to brush up on any electronic payment policies that you may have or may not have. How are you cutting checks to vendors? Are you relying on checks? From a liquidity perspective, when you cut a check, again, that money hasn't cleared the account, but from a general ledger perspective, it's gone. So what different options do you have available to you? Are you relying on going to the bank for deposits? It's a great idea to have a couple different banking partners that really specialize in different areas so that you can take advantage of what they do really well. A lot of times a bank may not tell you, I am not interested in long-term liquidity, because they want the whole relationship. But there are some banks that do great at having long-term strategic liquidity. And then there are other banks that do great on providing you commodity services, like sending an ACH and wires and having great online bank access. Are you relying on one option for taxpayers to pay taxes? Do you have an online portal? Things are going to change. There will be a new normal. Are you relying on getting paper statements? And finally, urging direct deposit. All of these have a great liquidity perspective and great implications to maximize the value that you have on every dollar. And it works with small entities and it works with large entities. And it's another option in your toolbox to be able to really take advantage of everything that you have available to you.
The last point I would make with that too, and thank you so much, Garrett, is just to let you know the amount of data that's going to be collected during this period of time is going to be so invaluable for you going forward for emergency preparedness. And I will tell you, the community colleges over the last 3 years, as you all know with counties, the community colleges have seen decreased enrollment because of a better economy. And they've had to do certain things to address to a new normal for themselves. And they've had to institute some different ways of dealing with liquidity that I highly suggest that you just talk to community college financial partners, the CFOs, to see how they've had to deal with some of the shortfalls, but yet they have been able to be very effective to meet their liquidity and meet the different challenges. And so I again commend all of you for what you're doing, and Steve for putting this together is a very useful tool, and thank you for including us.
Okay, thank you very much, Bob Keating. Let's go to you for the first question here. The question is concerning, the number of different federal revenue streams that are out there with Corona, FEMA reimbursements, U.S. CARES for the larger counties, revenue losses that are looming out there. Are there ways for the counties around the state to draw down federal funding, new funding for Meals on Wheels for seniors and new types of reimbursement streams?
Again, we're still kind of diving into the details. Going through the CARES Act, there are so many great provisions in there that, for programs. So maybe someone else could help with this one, but, I know there are a lot of things. I know we've talked to our senior services people, and there are some great provisions in there that they're going to tap into.
Okay. Thank you very much. The next question is, Bob, we'll stay with you. Are you doing any work with your business community locally on economic recovery councils, interacting with them to try to see the reemergence of the business community?
Ben, are you on this call from Ben Swanick? So we did establish a committee in Erie County. Ben probably could explain more of that if he's on the call.
Yeah, can you guys hear me?
Yes.
Yeah, so the county executive, in conjunction with our local Chamber of Commerce, the Buffalo Niagara Partnership, has established a business task force that is working on this issue. They launched a survey about 2 weeks ago now today that is being completed of local businesses to see what the best kind of assistance they need is right now and to gauge the impact of the COVID-19 crisis on their finances. And using that data, we'll put together a more refined local aid package if need be.
Okay, staying in Erie, thanks, Ben. Staying in Erie, Bob, how are you able to project your revenues when you're using a revenue anticipation note? It's hard to do in a normal economy.
Right, we're basically looking at every aspect, sales tax. I mean, every revenue that's out there, and even as area sales tax is, work with our controller's office. We have, federal revenue, state revenue, everything that's coming in, during the time of the RAN. So it's certainly difficult. It's not as easy as usual, but we do have enough revenue to pledge.
Let's go to Tim O'Hearn. Tim, did you factor in for your Department of Social Services layoff? Did you take into account the loss of reimbursement from these positions from the state of New York? Often 50 to 80% reimbursement, depending on what type of work the employees are doing?
Yes, we did, and there is some impact, but I'm glad that question was asked. That was a factor to consider as well, and it did, lower the local savings somewhat.
Okay, staying with you, Tim. If you're self-insured for unemployment, are you eligible to receive the unemployment aid regarding unemployment?
That's my understanding. In fact, this came on a NISAC conference call through outside counsel. We weren't even aware at the time of making the decision that as part of the federal stimulus package, public employers, and it's not we're eligible for the 50% reduction in cost. And my understanding is most public employers are self-insured. The assumption is that this will result in a reduced billing from the state for that.
Tim, staying with you, are you doing rolling furloughs?
At this time, no. All of the identified employees were furloughed at the same time. There may be rolling returns based on the recovery. That will be case by case as we are able to increase services or increase opportunities for employment. My preference certainly is to have people back on the payroll once we can justify it.
Mary, Tim, and Bob, any comments on mortgage recording tax?
Again, this is Bob. We certainly expect it to be reduced. Certainly they're not getting the foot traffic. They're taking steps to, for the social distancing in our clerk's office, to keep functioning. But certainly, things that are not critical are going to be delayed. And another thing, I was able to check on the like Meals on Wheels and so on. And the county is getting $645,000 through the CARES Act. Or through, Federal Response Act 1, not the CARES Act, to help with, our Meals on Wheels needs. So that is a positive.
Okay. Mary, Bob, Tim, how are county officials anticipating sales tax shortfalls, and how will that affect the town sales tax credit that some towns use to offset the county tax bill for their jurisdiction?
Again, Erie County do that.
Go ahead.
Ontario?
So I assume you mean the sales tax shares that we do with the municipalities?
Dave Lucas, are you on the line?
Well,
Yes, this is Mary.
Dave Lucas, are you on the line? I think it's not pertaining to the sales tax sharing agreements, or maybe it is, but there's a way that I think it has to do with the property tax cap.
Yeah, towns can elect to apply it as a credit to their levies. In Schuyler, none choose to do so. We have capped our sharing of sales tax with towns prior to this anyway, so our towns probably won't be impacted by loss of sales tax revenue significantly, nowhere near as much as the county will be.
So I've talked to several of our towns in Ontario County about the loss of sales tax, and one of their issues is the fact that the loss is not going to be even, if you will, across the board. So insofar as I'm not going to lose the same amount in May, June, July, August, it's going to be, the big impact is going to be early on this year. It's going to be in that second quarter probably, and obviously some in the third quarter. So I'm sort of advising them to look at that, even though the state comptroller says you don't budget this way and this is not the way you're supposed to look at things. I'm advising them to look at that on a cash basis when they're looking at what they may need to change operationally, because they will not have that cash to pay the bills. So they are using approximately the same percentages we are using, but they are estimating a little higher than we are, just to be able to cover that cash flow perspective, because they don't have the size fund balance that many counties have. So the impact is much greater on them from an operational standpoint.
Thank you, Mary. Did you use any outside experts or analysis to set up your statistics or projections, or was it done within your own office?
I completed those myself. That was just the way my mind worked, scary as it may be.
Okay, next question is, Bob, maybe to you. Are you able to reduce your indigent defense, Harrell Herring monies locally, or does anybody have an answer to that, or is that something that counties cannot cut local contributions to receive the additional state aid?
Schuyler's one of the Harrell Herring counties we've been told we cannot cut.
Ontario's been told the same thing.
Okay. Question here on early retirement. Is the state going to do an early retirement program for counties? We think they are going to do an early retirement incentive, but it's not something that's going to be talked about anytime soon. because they would rather have individuals likely going to retire through this period of time to just simply retire, as opposed to getting the additional years of service credit. But if you look back and think back to 2010 and what they did in the Great Recession, that's likely what they will be doing on a go-forward basis. Jerry in Broome County, are you with us? Do you want to share any observations? Okay. Next question is there any legislation or efforts to make a presumption of COVID for workers' compensation? And yes, there is legislation that has been put in that will give a presumption of COVID illness for first responders, and that will affect the counties. Of course, all of the volunteer EMS, volunteer fire, and other first responders are in county self-insured workers' compensation pools. For the over 100 of you that are on this call here this morning, there is going to be a potential impact for the workers' compensation and then the reinsurance that's tied to that. Another question concerning hazardous pay. Bob, or any of you on the line, any counties doing hazard pay?
Schuyler is not.
Ontario is not.
Yeah, Erie is not at this point, but there's been some pushback, I know, from our sheriff's unit that they would like it.
Question, how are county officials anticipating the sales tax shortfalls will affect town sales tax credits? I think we answered that one. I'm sorry. Question about, is anyone factored in the loss of mortgage recording tax revenue into their projections of revenue loss?
I have not projected mortgage tax revenue at this point in time.
Nor have I. It's not a significant revenue stream for us.
Okay. A comment here, basically regarding retirement. Even if the state offered a couple of extra months of service credit, we could allow employees who are going to retire this year to retire a couple of months sooner, and that could help us avoid layoffs. So we will bring that question to the state. But unless any of our panelists have anything else to say, I think we're reaching our time here, about an hour and 15 minutes in. Anybody else from the panelists want to have any closing comments? Okay, well, I'd like to thank everybody for taking the time to share your best practices and information that you have. I will post this information on our website. And thanks everybody again for all the great work that you're doing. That will conclude today's webinar. Thank you.